The silver price today is $82, more than twice as high. That means arithmetically silver is half as attractive because the price has doubled. People like it psychologically more because the price has doubled, but silver is no longer hated. It's no longer cheap. I bought a fair bit of silver because I thought it was oversold. It was cheap. My reason to own that silver has gone away. So I'm going to sell it. I'm not going to sell all my silver, but there was some silver that I bought in anticipation of it no longer being hated. It's no longer being hated. If making 40 while missing out on 20 is the worst sin I ever commit in my life, I've lived a pretty good life. Every time I make an investment personally, I write myself a little memo, page and a half about why I did it, what I think I'm going to accomplish and why, how much time it's going to take, and what could go wrong and what will make me sell. And with the silver in particular, the reason that I own the silver has been caused to occur. Could it go higher? Yes. Do I care? No. I'm going to be selling a little bit. To understand the simple arithmetic of speculation, when the price of something doubles, if the underlying factors haven't changed, the stuff is half as attractive. It's just math. It's half as attractive. U.S. small, well-run community bank stocks are cheap. Selling at 6 and 7 times earnings, wonderful businesses. I like boredom. I like profitable boredom. Oil and gas are fairly cheap. The oil and gas companies, particularly the better-run Canadian ones, are very, very, very cheap. Probably don't get paid for this bet in 2026, 2027. I think you get paid in spades in 2028. My suspicion is that we see nominal oil pricing in 2028 in the $80 or $85 range, maybe higher. And what that means is that free cash flows from today's level probably triple. Remember that the move from $55 a barrel to $85 a barrel is all margin. While the oil price doubles, what happens is the margins go up threefold or fourfold. And that's the biggest opportunity I see in front of me now. Net present value of unfunded entitlements, not the nominal value, but the net present value discounted, is $120 trillion. So add $120 trillion to $38 trillion. The number you get is $158 trillion in debt right now. So there's a $9 trillion margin. And it gets worse. I hate to laugh, but it gets worse. Those on-balance sheet liabilities that we talked about, the 38 trillion, they grow by 2 trillion a year. We're going to reduce the purchasing power of the currency units that we issue over the next 10 years by 75%. We're going to reduce the real value of $150 trillion in liabilities down to 37 or 38 or $40 trillion. That's what we're going to do. And the impact of that means that unless you increase your nominal earnings fourfold, your standard of living declines, guaranteed.
Legendary investor Rick Rule is taking profits on silver after its explosive 140% run. Why? Because at $82, it's no longer the hated, cheap asset he bought. Now he's rotating into deeply undervalued and overlooked sectors: U.S. community banks and Canadian oil stocks.
The purchasing power of our respective currencies, Canadian dollar and the U.S. dollar, declines by 75% over 10 years. What that means is that the basket of goods and services that cost you $1,000 to acquire today cost you $4,000 10 years from now. The aggregate net worth of American billionaires, according to the IRS, is $6.2 trillion. If rather than increase their taxes, you stole all their money, you would deal with a year and a half's worth of deficit without touching the debt. In other words, saying envy is good politics, but it's poor math. Gold price repeats the same performance. You remember that, well, you won't remember because you weren't born, but in 1970, the price of gold was controlled at $35. So the move from $35 to $100, a triple, was probably a coiled spring, a fake move. But the macro is distressingly similar. In the market that we saw in the 1970s to the 1980s, The US dollar hegemony was being challenged around the world, much as it is today. In the middle of that move, in 1975, the gold price fell by 50%. So in the early part of the bull market, people saw the gold price go from $35 to $200, and they were ecstatic, right? They drank the Kool-Aid, they had the coffee, they were hardcore gold bugs, right? All in. Then the price of gold falls from 200 to 100 in 9 months. And those religious adherents to gold were wishing to never learn to spell it. Guys who bought in feverishly at 175 were selling feverishly at 105, locking in $70 losses in 9 months. Getting shaken out meant that they missed a move from the end of 1975 to 1981 in 6 years. They missed a move in gold from $100 an ounce to $850 an ounce. I don't know if in this gold bull market you're going to get to participate in a 50% price decline, but I absolutely guarantee that you'll be able to participate in a 30% price decline. And whether you use that as an opportunity or whether it kicks your ass is entirely up to you.
His most urgent warning is about the terrifying math of U.S. debt, a staggering $158 trillion in liabilities that he says will force a 75% devaluation of the dollar over the next decade. He draws a direct parallel to the 1970s gold bull market, which saw a 50% mid-cycle crash and warns that the coming volatility will separate the prepared from the panicked. His final advice, stay optimistic and make volatility your ally.
Faced with a situation that was clearly inequitable, I had to act in my self-interest. I sold the house, shut down. This isn't a criticism of Canada necessarily. It's simply to say that you have to take control of your life. The government exists to plunder. They exist to transfer wealth, particularly from savers to spenders. Many people believe that their duty is to show up for a job, not to do the job, to show up, to spend some time in some mildly disagreeable task where they accomplish as little as possible and take home their paycheck. And those people are going to be real victims in the next 10 years. Many speculators speculate because they want to live rich, not because they want to be rich. Their idea of a good silver market is one that allows them to buy a Lamborghini. This is hugely problematic because the next 10 years are going to be much less benign than the last 10 years. It doesn't mean that people who keep their heads about them, people who use volatility as opposed to being used by volatility, don't do materially extremely well in the next 10 years. Although I don't need to, the next 10 years for me are going to be amazing materially. The dichotomy between what I achieve and what most people achieve is going to present real risks for me. Because people who didn't achieve the sort of pitchfork masses will look on me with some envy, not understanding the causes in the increase in delta between what they were able to do and what I was able to do, than the savings that they have generated from their own creation of utility. The people who create the most utility relative to what they consume are the people who get richest. Now, understand that in a democracy, there's a fairly few number of people who generate utility. You're probably familiar with Pareto's law, the suggestion that 20% of the population generates 80% of the utility. But 20% of the population has 20% of the votes. An election, and I'm not anti-democratic, I just don't want them to be able to decide much. An election is really statistically very much like having 4 wolves and a lamb vote on a lunch menu. You know, pretty clearly, lamb is going to be on the lunch menu. And if you have a circumstance in society where 28% of the people generate 80% of the utility, and as a consequence, accrue 80% of the gain, the people who generated less utility are going to experience envy. And they're going to reflect that at the ballot box. The way people get elected is to lie, is to say to them, you, the 80, deserve the utility generated by the 20. But all the sub-thugs in government are still there. The thugs control the military. The thugs control the People's Assembly. The thugs control the Treasury. The thugs control the state government, the local governments. Nothing has changed. The idea that Venezuela was suddenly liberated, whatever that means, and that regime changes occurred is not true. The fact that there's consensus that the U.S. is going to take over Venezuela's oil industry is only a truism to those people who don't understand Venezuela. It may occur, but it won't occur for months, and it won't be bloodless. So people need to understand that. The overnight trade, the news trade, is like all other news trades. It's fraud. You need to think in the long term, not reflexively. The oil business, of course, goes beyond that. And it's partially a narrative trade, too. The popular part of the narrative is that oil is bad. Energy, cheap energy, has been responsible for the material ascent of humankind. Material living standards vary in league with energy consumption. And if what you want is to return to the world that we enjoyed 50 years ago, where 40% of the human population was desperately poor, facing starvation, then you can be anti-oil. But if you believe that desperately poor people enjoy access to the same living standards that you enjoy, you have to be pro-oil. So people who wish for the end of oil need to understand that what they wish for is starvation and poverty. They need to think of it in that context. Oh my goodness, people say, global warming. We can't afford for these poor people to be rich. Fine, send them some money. You send them some of your money. When we're talking about carbon, we're talking about a circumstance where all of the price of that will be borne in the West, if it happens. In Canada and the United States, we say about carbon consumption that we need to measure carbon output by nations. But poor countries that have lots of people in places like India say, no, we need to measure it per capita. So rich Western countries that use a lot of carbon have to pay disproportionately because they use disproportionately per capita. All people are the same, whether they're Indian or Canadian or American, which, by the way, is true. And then the poor countries say, we need to take into account historic carbon loadings. The problem, if the problem exists, is 95% a consequence of oil that has been burned over the last 50 or 60 years. And guess what? That's all occurred in developed nations. The point of all this is that whether or not we want to address the problem, we're not going to address it. If you say to the Canadian voters, we can address the problem equitably, but your standard of living declines materially. The cost of your gasoline goes to $5 a liter or $6 a liter. The price to heat your home goes up fourfold. So if what you really want to do is save butterflies, write a big check. Write a big check. If Mr. Carney was honest with Canadians and said, we can do all these things, to do it is going to reduce your disposable income by 25%.